Graph reading is an essential skill for understanding stock market trends and making informed decisions. Stock charts, or graphs, provide a visual representation of a stock's historical price movements and can help identify trends, support and resistance levels, patterns, and other technical indicators. Here's an overview of key concepts and elements in graph reading for the stock market. 1. Types of stock charts. Line charts, a simple chart showing the closing price of a stock over a period of time, connected by a line. This chart is easy to read but lacks detail, such as the opening price or intraday volatility. Bar charts. Each bar represents the price range, high to low, for a specific time period, e.g. daily. The top of the bar shows the highest price for the period and the bottom shows the lowest. The vertical line indicates the price range, while horizontal lines show the opening, left, and closing, right prices. Candlestick charts. Similar to bar charts but visually more distinct. Each candlestick represents the price movement for a specified time. The body represents the range between the opening and closing prices, while the wicks, lines above and below, represent the highest and lowest prices during that time. Candlestick patterns are widely used for identifying trends. 2. Key components of stock charts. Time frame. The x-axis represents time, which could be in minutes, hours, days, weeks, months, or years, depending on the chart's timescale. Price scale. The y-axis represents the price of the stock. Volume. Typically shown as bars beneath the price chart. It indicates how much of the stock was traded during a particular time period. High volume can indicate strong interest, while low volume might suggest weak interest or a lack of conviction. 3. Identifying trends. Uptrend, bullish. If a stock's price is consistently moving higher, it is considered to be in an uptrend. You'll see a series of higher highs and higher lows. Downtrend, bearish. If the stock price is consistently moving lower, it's in a downtrend, with lower highs and lower lows. Sideways, Johnny flat trend. When the price moves within a range without any clear upward or downward direction, it indicates consolidation or indecision in the market. 4. Support and resistance support. This is the price level at which a stock tends to find buying interest, preventing it from falling further. It acts as a floor for the stock price. Resistance. This is the price level where selling pressure tends to emerge, preventing the stock from moving higher. It acts as a ceiling. These levels can be visualized as horizontal lines on the chart and are important for traders as they often predict where the stock price may reverse. 5. Chart patterns, head and shoulders. A pattern indicating a potential reversal. The head is the highest peak, and the shoulders are the smaller peaks on either side. A head and shoulders top suggests the price will reverse downward, while an inverse head and shoulders indicates a possible reversal upward. Double top and double bottom. These patterns indicate potential reversals. A double top forms after a stock, hits a resistance level twice and fails to break through, signaling a potential downward reversal. A double bottom occurs after the stock hits a support level twice and fails to break below it, signaling a potential upward reversal. Triangles. These patterns form when the price moves within converging trend lines, creating a triangle shape. A breakout from the triangle pattern, either upwards or downwards, often signals the next significant price move. 6. Technical indicators, moving averages, MA. A moving average smooths out price data to create a trend-following indicator. Common types are the simple moving average, SMA, and the exponential moving average, EMA. Crossovers between short-term and long-term moving averages, e.g. the 50-day MA crossing the 200-day MA, are considered signals for potential buy or sell opportunities. Relative Strength Index, RSI, an oscillator that measures the speed and change of price movements. RSI values above 70 typically indicate that the stock is overbought, potentially overvalued, while values below 30 suggest the stock is oversold, potentially undervalued. MACD, moving average convergence divergence. A trend-following momentum indicator that shows the relationship between two moving averages of a stock's price. A MACD crossover can indicate a change in momentum. Bollinger Bands. These bands are placed two standard deviations away from a simple moving average. The price moving outside of the bands can suggest a stock is overbought or oversold, or that volatility is increasing. 7. Volume analysis. Volume is a crucial part of chart analysis. It represents the number of shares traded and can help confirm the strength of a price move. For example, high volume during uptrend indicates strong buying interest, which supports the price increase. High volume during downtrend indicates strong selling pressure, confirming a downward move. Low volume suggests a lack of conviction and that the price movement might not be sustainable. 8. Candlestick patterns. Candlestick charts are often used for detailed analysis. Some key candlestick patterns include bullish engulfing, a large green candlestick that completely engulfs the previous red candlestick, indicating a potential upward trend. Bearish engulfing, a large red candlestick that engulfs a smaller green candlestick, indicating a potential downward trend. Doji, a candlestick with an opening and closing price that are nearly the same, often signaling indecision and potential reversals. 9. Using multiple indicators together. Confirmation. It's essential not to rely on just one indicator. Combining indicators such as moving averages, RSI, and candlestick patterns can give more reliable signals. Divergence. Divergence between price and indicators, like RSI or MACD, can signal potential trend reversals. For example, if the price is making new highs, but the RSI is not, this could signal a weakening uptrend. Conclusion. Reading stock graphs effectively involves understanding patterns, identifying key levels like support and resistance, using technical indicators, and analyzing volume. By combining these elements, traders and investors can make more informed decisions about entry and exit points in the market. While technical analysis is powerful, it is important to remember that it is not foolproof and should be used in conjunction with other forms of analysis and risk management.